Have you ever wondered if you're paying too much for a stock? Are you eager to discover the perfect time to make that investment? Well, you're in the right place. Welcome to the channel. I'm Jack of all trades, and today I'm going to unveil the secrets of when you're overpaying for a stock and when the golden opportunity might be knocking. Don't click away just yet. The answers you've been seeking are just around the corner. Let's dive in. Enjoy the video. What is the difference between price and value? Price is what you pay, value is what you get. The famous quote of Warren Buffett summarizes the idea of value investing. Knowing the difference between price and value is key for deciding if you're paying a good price for a stock. Price is simply the amount of money you pay for an investment. It can be determined by a variety of factors, including supply and demand, news events, and investor sentiment. Value, on the other hand, is the underlying worth of an investment. It's based on the company's fundamentals such as its earnings, cash flow, and growth potential. Let's dive into the concept of price first. Price is what you pay. The price of a stock is the amount of money you pay to purchase the stock. The current price is determined by the supply and demand of the moment. There are many factors that can influence the supply and demand. Company sentiment. The perception of the company can have a significant impact. Positive news such as product launches or strong earning reports can boost sentiment and stock prices, while negative news can have the opposite effect. Investor sentiment. Not every action on the stock market is rational. A lot of people copy the sentiment of others, which can lead to a massive rise or fall in the stock price, while the underlying company might barely have changed. Economic conditions. Broader economic factors such as interest rates, inflation, and economic growth can affect stock prices. For example, rising interest rates can make stocks less attractive compared to other investments, leading to price decline. Industry trends. The performance of a stock can be influenced by trends within its specific industry or sector. If a particular sector is booming, companies within that sector may see the stock price rise. Company performance. The financial performance of the company itself is a fundamental factor. This includes factors like revenue earnings, profit margins, and growth prospects. Positive financial results often lead to higher stock prices. The stock price is determined by the market. This market is referred to by Benjamin Graham as Mr. Market in his renowned book, The Intelligent Investor. Mr. Market represents the stock market and its daily price fluctuations. In Graham's metaphor, Mr. Market is an imaginary character who offers to buy and sell his share of a business to investors every day at a specific price. Some days Mr. Market is euphoric and offers a high price for the business, while on other days he is despondent and offers a low price. Value is what you get. The price is what you pay for the stock, but the value is what you get. The stock you buy has an underlying value. This value is determined by factors like a company's financial health, earnings potential, and long-term prospects. The value of a company is often a more stable and reliable indicator of an investment's true worth compared to the short-term price fluctuations. Let's compare it to the newest iPhone 15. Let's just say that we determine that all the functionality and joy it brings to our lives gives it a value of $5,000. This $5,000 is what the iPhone is worth. But this is not the same as what you are paying for it. Depending on the version that you buy, the price of a new iPhone ranges around $1,000. So by paying $1,000, you will receive a value of $5,000. If this underlying value was true, then buying an iPhone sounds like a bargain. The same goes for stocks. You pay a price, but the value is not necessarily the same. Of course, in this example, I could have also argued that the value of an iPhone was $500. It basically offers the same functions as cheaper phones, so the value is more similar to them. In that case, paying $1,000 for something with a value of $500 would have been a bad purchase. You also don't want to pay a higher price for a stock than the underlying value of that stock. The big challenge is how to determine the underlying value of a stock. The price is what you see in your app or on the board, but the underlying value is based on assumptions about the future, and that future is not certain. This is the big challenge of investing, determining what the value of the stock is. Take advantage of the difference between price and value. So we know that a stock is worth its underlying value, but that the price that you pay for it is determined by Mr. Market. When the price of a stock is lower than its value, then this gives the investor an opportunity. Graham's main point in introducing the concept of Mr. Market is to highlight that investors should not base their investment decisions solely on Mr. Market's daily price quotations. Instead, they should focus on the underlying value of the businesses they are investing in. This is also referred to as value investing. Value investing involves calculating the intrinsic value of a company and then compare this intrinsic value to Mr. Market's offering price. Graham advises investors to take advantage of Mr. Market's irrational behavior by buying when he offers low prices, undervalued stocks, and selling when he offers high prices, overvalued stocks. In other words, investors should be contrarian and buy when others are fearful and sell when others are greedy. Warren Buffett, who is one of the most successful investors of all time and a disciple of Benjamin Graham, has often spoken about the concept of Mr. Market and how it influenced his investment philosophy. He has famously said that Mr. Market is there to serve you, not to guide you, emphasizing the idea that investors should use Mr. Market's fluctuations to their advantage, rather than being swayed by his emotions. In summary, the concept of Mr. Market serves as a powerful reminder for investors to focus on the intrinsic value of businesses, rather than being swayed by the daily ups and downs of the stock market. When you ignore the underlying value of a stock, then you can easily fall into traps, like speculative bubbles or overvalued assets. So now we know the importance of understanding the difference between price and value for successful investing. Take advantage of this understanding. Don't let it go against you. Thank you for watching my video. If you made it this far in the video, then you must have liked it. So please subscribe to my channel so you will receive more videos like this. If you have any questions, feel free to leave them in the comments below and I will make sure to respond. See you next time.